weekly FX update brought to you by ECN. This week FX commentary we will discuss and break down the pound-dollar market. A turnaround for the pound-dollar market this week as technical indicators turn bullish on the cable. However, UK fundamentals continue to remain weak as expectation for a rate hike by the BOE weakens. With the FOMC meeting taking place this week, the market is bidding on a change in the 0% interest rate policy by Yellen on the back of an improving US labor market as well as fundamentals. First, in line with this commentary, we will break down the pound-dollar market on the technical front. The pound-dollar market recovery appeared to be gaining traction on the back of this week's trading session after bottoming out at the 1.5950 level. Since then, the pair has taken over the psychological 1.600 level. During last week's bottoming process, the price action of the pair appeared to be forming the bullish piercing line candle pattern, which is evidenced during a short-term bullish rally. Currently, the pair is trading between the 23.6% Fibonacci expansion, which formed the intermediate resistance at 1.62545, while the 38.2% expansion forms the support tier at 1.60881. And according to the SSI, which is commonly known as the Speculative Sentiment Index, retail traders' position on the pound-US dollar pair is very indicative of a ranging trend. This is self-evident in the retail open long position and short position trap and conversion pattern. Currently, retail long position is sitting at a ratio of 1.5 to 1 to short position outstanding. Therefore, contrarian stage trading would suggest further weakness in the pound sterling. Analysis of a collection of technical indicators on the hourly time interval on the pound-dollar market is suggestive of a temporary bullish market sentiment and recommend short position on the greenback. The pound-dollar pair opened today's Sydney trading session inching closer to the established support at 1.6073, while the resistance is set at 1.6121. The pair hasn't managed to break above the 200-day simple moving average, which allowed the market to continue to revise the long-term outlook on the cross to bearish if it continued to hold above the 200-day simple moving average. The significance of the 200-day simple moving average cannot be understated, as 200-day simple moving average contain more or less of 1 year's worth of trading data. This bearish sentiment, however, is not shared by the short-term moving average front, as the pair opened today's Sydney trading session above the 5, 10, 20, and 30-day simple moving average, which is indicative of a buy recommendation on the moving average front. Moving along to the fundamental aspect of the pound-dollar market, the fundamentals underlying the pound sterling are the most robust compared to the other G5 FX counterparts, and since the Scottish referendum worries are nothing but the past, investors are bullish on the pound as they begin pricing in a 50 basis point rise in the UK benchmark rate over the next 12 months. The downturn in the pound sterling began back in mid-July and continued to decline in mid-September, can be attributed to the UK leading economic indicators rolling over and coming in softer than expectation. Therefore, the perspective of rate tightening is weaker than how it was a few months ago, as the MPC members will encounter difficulties in collecting a 5-vote majority to deliver a rate hike. The implication of a neutral BOE during the next BOE meeting would only further diverge the monetary policy differential between the BOE and the Fed. As rate tightening expectations continue to erode, this will only work to burden the momentum for further pound weaknesses in the medium term. Compared to last week's trading session, this week is relatively muted in terms of risk opportunity affecting the pound. For instance, yesterday UK industrial production month-on-month for August stagnated when expectation forecast at 0.2% expansion. In addition to that, the UK manufacturing production month-on-month came in line with expectation by growing in at 0.1%. For the remaining of this week's trading session, the market can expect the release of Halifax House Price Index month-on-month forecast to come in at 0.2%, while on Thursday the BOE will release its QE total for the month of October forecast coming at 375 billion. Meanwhile, the BOE interest rate is expected to remain at 0.5%. Wrapping up this week's trading session is this Friday UK trade balance for August expected to come in at 9.60 billion in deficit. I want to thank all our listeners for listening and spending their time with us, and have a successful trading session, everybody.